Hi there and welcome back to Ducrozet TV. I'm Ben Jones. There's a worry that some domestic policy changes in Germany could hinder growth. So joining me on the line to give his insight is Frederik Ducrozet from Crédit Agricole. So Frederik, Germany's economic situation at the moment is said to be on an upswing, with growth expected to hit 2% in 2015. However, domestic issues in Germany may halt this upswing and cause the growth to waver. Could you talk about the potential damaging effects of lowering the retirement age and increasing the minimum wage?
Well, I can hear that's a kind of criticism in the German financial press in particular, but I think you should stick to the facts here. In Germany in particular, domestic demand, both consumption and investment spending, have actually been the main drivers of growth for most of the recovery so far. So it's not a new thing, and it's not necessarily a threat to the German economy that the domestic conditions are improving. In my opinion, quite the contrary. Relative loss of competitiveness, for instance, has been fairly limited so far. Unit labor costs in Germany relative to Spain and other countries have increased, but not to a very large extent. And last but not least, I would say that public finances in Germany are in a very good shape. Tax revenues in particular are exceeding expectations. So my view is that the pension system in particular is sustainable at this time. That's not to say that in the very long term, weaker demographics in particular will not call for further adjustment, but so far, a modest increase in some of the minimum wage settings in particular, a modest lowering of the retirement age, are no big threat to the German economy, in my opinion.
So you don't feel there'll be any damaging effects from these issues. So what do you think the key drivers will be for Germany?
Yes, indeed. It's in the forecast. It's a key assumption of the German government in particular that domestic consumption, domestic investment spending as well will continue to support growth up to 2% in 2015, and the labor market in particular is in a very good shape. That is another argument for that. It's kind of ironic, I would say, that Merkel is facing opposite kind of pressure at the domestic and external level. In Germany, she has been criticized for those kind of reforms, the lowering of the retirement age, the increase in the minimum wage, but from its EU partners, Germany has been criticized for the opposite, maybe for lack of action or not bold enough support of its domestic economy. So it's a fine line that Chancellor Merkel has to work here.
And finally, it's a busy week of data for Germany next week, with retail sales and the all-important inflation rate. Do you think Germany can reverse the inflation downtrend they're seeing at the moment?
Yes, indeed. We are looking for a quite sharp rebound in German inflation next week. The Easter effect in particular will be reversed, so German inflation should jump back well above 1% in April. And on the other side, retail sales have been very strong in the first 2 months of this year, so I would expect a setback in March. Again, the bottom line of all this is that the Eurozone rebalancing and this recovery needs Germany to rebalance as well. And inflation needs to go up, domestic consumption needs to be sustained for the adjustment in the periphery, in particular of the Eurozone, to be sustainable. So higher German inflation is a necessary evil from that perspective.
Frederik, thank you for talking with us today. That's all we've got time for, I'm afraid. Thanks for watching, and make sure you join us again next week. But for now, goodbye.